The U.S. government needs money to run its affairs and programs. How does the U.S. government borrow money? The answer lies in U.S. Treasury Securities. These are debt instruments that have a very low risk of default, which means that the government promises to pay back the principal and interest on time and in full. This makes them very low-risk investments, as the chances of the U.S. government defaulting on its obligations are extremely low. There are different types of Treasury securities, depending on their maturity and interest rate structure. The main ones are 1. Treasury bills, or T-bills, which expire in less than a year. They are sold at a discount and pay no interest, but you get the full face value at maturity. 2. Treasury notes, or T-notes, which have maturities of 1 to 10 years. They pay interest every 6 months and have a fixed coupon rate. 3. Treasury bonds, or T-bonds, which have maturities of more than 10 years. They also pay interest every 6 months and have a fixed coupon rate. 4. Treasury inflation-protected securities, or TIPS, which have maturities of 5 to 30 years. They pay interest every 6 months and have a fixed coupon rate, but their principal value is adjusted for inflation based on the Consumer Price Index. 5. Floating rate notes, or FRN, which have maturities of 2 years. They pay interest every 3 months and have a variable coupon rate that is based on the 13-week T-bill rate plus a spread. So how can you invest in these Treasury securities? There are several ways to do so. 1. You can buy them directly from the U.S. government through its website treasurydirect.gov. This is the simplest and cheapest way to buy treasuries, as you don't have to pay any fees or commissions. You just need to open an account with your personal information and bank details, and then you can bid for treasuries in online auctions or buy them at fixed prices from the secondary market. 2. You can buy them through a bank, broker, or dealer. This gives you more flexibility and convenience, as you can access a wider range of treasuries and hold them in your brokerage account or IRA. However, you will have to pay fees or commissions for their services, which will reduce your returns. 3. You can buy them through exchange-traded funds. These are funds that track the performance of an index of treasuries with different maturities or characteristics. However, you will have to pay management fees and expenses for it, as well as bid-ask spreads when trading them. As you can see, investing in treasuries has many benefits and options for different investors. They offer safety of principal, regular income, tax advantages, liquidity, and diversification. But they also come with some disadvantages and risks, such as 1. Low returns. Because treasuries are so safe, they also offer low interest rates compared to other investments. This means that you may not earn enough to beat inflation or achieve your financial goals. 2. Interest rate risk. This is the risk that the value of your treasuries will decline when interest rates rise, as bond prices and interest rates move in opposite directions. The longer the maturity of your treasuries, the higher the interest rate risk. 3. Reinvestment risk. This is the risk that you will not be able to reinvest your interest payments or principal repayments at the same or higher rate when your treasuries mature. Therefore, before investing in treasuries, you should consider your risk tolerance, income needs, and financial objectives. You should also compare the returns and cost of different treasuries and methods of buying them, and diversify your portfolio with other assets that can provide higher returns or hedge against inflation or interest rate changes. I hope you found this video helpful and informative. Please leave a comment below and let me know what you think about it. Thank you for watching and happy investing.